Welcome to our comprehensive investment guide aimed at beginners who want to join the ranks of millions of individuals worldwide currently investing in the S&P 500. We'll start this journey by defining the S&P 500 and why it is an excellent option for long-term investing. The Standard & Poor's 500, more commonly referred to as the S&P 500, is a stock market index that measures the performance of approximately 500 of the largest companies listed on the U.S. stock exchanges. It acts as a barometer for the overall health of the American economy. Diving right in, the first step in starting your S&P 500 investment journey is understanding the index and how it's calculated. The S&P 500 is a market cap weighted index, meaning that companies with a higher total market value account for a larger portion of the index. Knowing this, when you invest in the S&P 500, you're essentially investing in a diverse range of well-established, stable companies that are the backbone of the U.S. economy. Now that you understand what the S&P 500 is and its significance, let's move forward and discuss how you, as a novice investor, can start investing in this index. Your journey begins by choosing the right investment platform. An online brokerage account can provide access to the S&P 500. Do your research, compare platforms, and choose the one that aligns with your investment goals and ways of working. Consider factors such as minimum investment amount, fees and expenses, and the availability of educational resources and customer support. This will ensure a smooth and seamless investment process. Once you've selected the investment platform that best suits your needs, you can move on to deciding how you would like to invest in the S&P 500. Two popular options used by beginner investors are exchange-traded funds, ETFs, and mutual funds. ETFs and mutual funds are both collections of stocks, bonds, or other securities. They offer instant diversification for investors, spreading risk across many different investments. However, there are also key differences between the two, from how they're managed to the fees investors pay. ETFs trade on an exchange, just like a stock, and their prices fluctuate throughout the trading day. They also tend to have lower expense ratios or management fees than mutual funds, making them a cost-effective way to track the S&P 500. On the other hand, mutual funds are valued once a day, usually after the market is closed. They traditionally have higher fee structures, but they also provide more robust tools for long-term asset accumulation, including fixed regular investments that average out the cost over time. Now that you've explored the available options, it's time to put your plan into action by making your S&P 500 investment. You're about to become part of the big, vibrant pool of investors who believe in the expansive potential of the S&P 500. Congratulations on taking your first step toward investing in the S&P 500. Amid the excitement of your newfound investment journey, remember one crucial concept: time in the market is more important than timing the market. In other words, the longer you remain invested, the more you stand to gain from the inherent growth potential of the S&P 500. With time on your side, you should focus on building and maintaining your portfolio. Remember the basic principles of investing: the importance of diversification, the significance of being patient, and continuously increasing your investment holdings when possible. Using additional income and returns from existing investments to build your portfolio over time is a proven way to grow wealth. This wealth-creating strategy is facilitated through a concept known as dollar cost averaging, DCA. By regularly investing a fixed amount in a particular investment, you're purchasing more units when prices are low and fewer units when prices are high. This helps smooth out short-term market volatility and may result in a lower average price per share over time. To ensure your portfolio is in good shape and aligned with your financial goals, you'll need to monitor it regularly. Keeping an eye on your investments enables you to make any necessary modifications, either to take advantage of fresh opportunities or to guard against potential risks. However, over-monitoring and making frequent, emotion-driven changes to your portfolio can be harmful, leading to higher fees, increased taxes, and possibly lower returns. Remember, investing in the S&P 500, or any investment for that matter, is a long-term endeavor. Stay focused on your financial goals and avoid the urge to react to short-term market fluctuations. For particularly risk-averse investors, investing in a broad market index ETF like the S&P 500 could be the single investment you need to get started. It's a tried and tested way to get exposure to the U.S. stock market, without having to undertake the daunting task of researching, buying, and managing individual stocks. Additionally, being a passive investment, buying and holding the ETF means you won't have to worry about timing the market or making frequent trades, which could potentially incur high fees. It frees you up to focus on your original goal, enriching yourself over the long term. It's important to acknowledge that a market index, including the S&P 500, will have its ups and downs. It's unavoidable and is part of the cycle of stock investing. Historically, however, the market has proven to bounce back, which is why it's important to stay invested and resist the impulse to pull out during a downturn. your S&P 500 investment journey will be a fulfilling and educating one. As you move forward, you'll grasp a plethora of financial concepts, starting with the significance of the S&P 500 to understanding different types of investment vehicles like ETFs and mutual funds. You'll learn to monitor your portfolio and adjust your investment strategies accordingly. Remember, learning to invest doesn't necessarily require an in-depth background in finance. The widespread availability of online resources, coupled with the easy access to a multitude of online brokerage platforms, provide individuals with a level playing field to kickstart their investing journey. With due diligence and consistent effort, investing in the S&P 500 can lead to the realization of your financial goals. It is a proven long-term performer and forms a solid foundation for your investment portfolio. Being aware of the risks, being patient, and staying informed will ultimately lead to success in your venture. Your journey doesn't stop at investing in the S&P 500. As you gain more knowledge and experience, you can look to expand your portfolio by exploring other investment commodities and financial instruments. Understand, though, that expanding your portfolio does not only mean investing in more products, but also investing in different sectors, or even different global markets. Furthermore, as the market evolves and new investment opportunities emerge, you'll need to reevaluate your investment strategy from time to time to ensure it is in line with your investment objectives. This might mean adjusting your risk profile, the types of investments you hold, or how much you have allocated to each investment. Your journey to financial freedom is your own. How fast or how far you want to go depends on your dedication and learning curve. Challenges are part and parcel of the journey, but don't be discouraged by setbacks. Learn from them, adapt, and keep moving forward. Remember, every successful investor started exactly where you are right now. The universe of investing is fascinating. It's a journey of continuous learning and exploration. Remember, each step you take, each dollar you invest is a step closer to achieving your financial goals. And the journey, filled with twists and turns, ups and downs, is as rewarding as the destination itself. So go ahead, make the S&P 500 your embarkation point. Arm yourself with the knowledge you gather, the strategies you develop, and the resilience you'll inevitably need. Before you know it, you'll find yourself at the threshold of becoming the captain of your own financial ship. As the journey reaches its conclusion, a final piece of advice: follow the age-old economics adage, don't put all your eggs in one basket. Diversification, or the practice of spreading your investments among different asset classes to reduce risk, is a key strategy to remain resilient under varying market conditions. So, take on the mantra of learning, unlearning, and relearning as you navigate through the financial maze. Begin with the knowledge that you are one among millions of investors in the S&P 500. Your portfolio may look small today, but with patience, dedication, and a disciplined approach, it will inevitably grow over time. Investing in the S&P 500 is an excellent starting point for your financial journey. As you progress, you'll understand that while the journey can initially seem murky, with perseverance and patience, it will eventually quench your thirst for financial knowledge and independence. As much as a spectrum of opportunities exists in the world of investing, so do the attendant risks. Acknowledging and understanding these risks is the first step to managing them. And while there may be possible losses along the way, it's the potential gains that make the journey towards long-term financial prosperity worthwhile. So welcome to the world of investing in the S&P 500. May your journey towards financial independence be fulfilling, educational, and most of all, prosperous. Armed with this information, take your first steps into the world of investing. Remember, the key to financial success is knowledge, patience, and perseverance.